This chart tracks the widening gap between the median American net worth and the top 10%, which currently requires a baseline of $1.06 million. Entering that top bracket is a function of identifying and eliminating the systemic inefficiencies where your capital drains away unnoticed. The largest of those inefficiencies is sitting in plain sight: $18 trillion currently held in commercial banks, earning almost zero interest. Most people spend their mental energy on complex investing jargon, while simultaneously losing wealth through foundational errors in how they store and spend their cash. We are going to analyze the strict return on investment for common financial behaviors to see exactly which inputs move the needle and which are mathematical traps. A stalled net worth is often the result of conforming to standard financial habits that mathematically guarantee stagnation. To lower their monthly payments, buyers are increasingly stretching car loans out to 84 or 96 months. This graph illustrates the trade-off. By extending the loan, you maintain cash flow, but the vehicle's value drops faster than you pay off the principal. Because of this gap, the average person carries $6,754 in negative equity. Buy now, pay later programs create a similar drag on wealth. These are now a primary tool for households earning over $100,000 to finance lifestyle purchases. The pitch of zero-interest installments removes the psychological friction of spending, leading directly to a 24% late payment rate among users. Convenience-driven debt like this acts as an anchor on your net worth, forcing you to use future income just to pay for past depreciation. This lack of margin makes the average household fragile. 60% of Americans cannot afford a basic $1,000 emergency expense. Even when savings exist, 57% of people keep that cash in traditional accounts, earning a national average of roughly 0.4%. Storing cash in these low-yield accounts offers familiarity, but it guarantees a loss of purchasing power to inflation every year. This chart compares the results of holding $5,000 for 1 year. A traditional account generates $20 in interest, while a 3.5% high-yield account generates $175 for the same level of risk. Using a traditional bank for your safety net is essentially paying a hidden tax for the sake of mere convenience. That same passivity creates friction in the investing world, particularly when people move their retirement funds. When rolling over a 401k to an IRA, many people assume their brokerage automatically invests the money into the market. In reality, as this flowchart shows, the money lands in the new account as cash. It stays there until the owner makes an active decision to buy into a fund. Because of this misunderstanding, 28% of people leave their rollovers in cash, missing out on the market's historical 8 to 10% average annual returns. We see the same need for active management in housing. Renting avoids the hidden costs of taxes and maintenance, but it only builds wealth if you actually invest the difference in cost. Relying on the financial system to automate your growth leads to significant, avoidable gaps in your total wealth. Active allocation is a requirement. For those starting their financial journey, the most important trade-off is choosing between a high savings rate and a high return rate. This chart tracks a race between two strategies. Investor A saves 10% of their income, but earns a 1% return. Investor B gets a 10% return, but only saves 5%. Despite having a return rate 10 times lower, Investor A reaches the $100,000 goal in 9.6 years, beating Investor B by more than 2 full years. At the start of the journey, the sheer volume of cash you contribute is the primary driver of growth, outweighing the impact of the return rate. Effort chasing higher yields is mathematically less effective than simply engineering a higher baseline savings rate. We map these behaviors onto an optimization hierarchy of effort versus impact. The top left quadrant, low effort, high impact, is the highest priority, like opening high-yield accounts and investing IRA cash. For beginners, the top right quadrant, maximizing savings rate, requires more effort but yields the highest ROI. If you have a middle-class income but your wealth is stalled, audit your lifestyle debt. Use the 24-10 rule for car purchases to avoid the negative equity trap. And if you are in a higher income bracket, audit your brokerages today to ensure your rollover funds aren't decaying in a cash settlement account. Taking immediate action on these specific friction points is what separates the top 10% from the median. Real wealth is built by optimizing the foundational inputs and allowing the math of time to do the heavy lifting.